Hey everyone, John AG here. If you're watching this right now, you picked one of the wildest mornings I've seen in years, because gold and silver are not moving, they're detonating. And the scary part? This isn't a meme stock spike. This isn't a weekend rumor. This is what it looks like when the world starts doubting paper promises at the exact same time. It's Thursday morning, January 22nd. While you were asleep, gold blasted up into the $4,700, and silver is trading around the low to mid-90s. I'm not exaggerating. I checked the screen in the middle of the night and my brain instantly went, okay, something just broke. Now, before we go any further, quick favor. My analytics show a huge chunk of you watch these videos regularly, but you haven't subscribed yet. If you get value from my work, hit subscribe right now and drop "Our John AG" in the comments so I know you've got my back. All right, here's what we're doing today. I'm going to connect three fires that look separate on the surface, but underneath they're feeding the same monster. A confidence crisis in government debt and in currencies built on that debt. First, the geopolitical shock that's shaking Europe and the US trade relationship. Second, the bond market stress that is quietly turning into a global funding problem. Third, Japan, yes, Japan, sending a message so loud it's rattling the entire world. And after we walk through those, I'm going to answer the question that really matters. What happens next? What's the playbook the central banks always reach for? And what normal people can do before the next phase hits? Because there is a next phase, and it's closer than most people think. Let's start with the headline chaos. You've got the US administration escalating its pressure campaign over Greenland and floating tariff threats on multiple European countries. Europe, meanwhile, is talking countermeasures and emergency meetings. Here's why that matters to your money. Markets can handle bad news. Markets can even handle ugly news. What markets cannot handle is unpredictable news, especially when it comes from the world's largest economy and the issuer of the world's reserve currency. Uncertainty is gasoline, and when you light it near debt, you don't get a normal fire, you get a debt fire. A lot of traders are framing this as a "sell America" moment. Global investors backing away from US assets because they don't like volatility, policy risk, and the smell of inflation. But I want you to think one layer deeper. This isn't about feelings, this is about math. The United States is staring at a refinancing wall, massive amounts of debt that has to be rolled over at whatever interest rates the market demands. And when confidence wobbles, the market demands a higher price for lending money. That's what yields are, the price of trust. If fewer buyers want your bonds, you have to pay them more to show up. So when you hear yields are rising, what you're really hearing is the world wants more compensation to hold the promise. And here's the part that gets overlooked. Even with all the talk about global diversification away from the dollar, there's still enormous foreign exposure to US debt. This is not some clean, overnight collapse where everyone dumps everything at once. It's more dangerous than that. It's a slow shift in preference, a gradual repricing of risk, happening while the debt keeps expanding. And if you want the most brutal signal of all, look at interest. When a government starts paying interest costs that rival the budgets of entire departments, that's not a line item. That's a gravitational force. Because once interest becomes one of the biggest expenses, the government has two options: cut spending or find a way to fund it. And politically, cut spending is a fairy tale. So the real option becomes fund it through more borrowing, more liquidity, more financial engineering, which ultimately means more currency creation, one way or another. That's why gold and silver are acting like they've been released from a cage. Now, I know what some of you are thinking. John, the Fed can cut rates and fix this. Listen carefully. The Fed influences the short end of the curve. The bond market sets the long end. And long-term buyers don't care about one little rate cut if they think inflation risk and volatility risk are climbing. That's why you can have rate cuts and still see long yields stay stubborn, or even jump. And when long yields jump while debt is rolling over, it's like refinancing your house every few months, except the mortgage keeps getting bigger and the bank keeps changing the rate. Now, pause for 2 seconds and look around. If you're a pension fund, a bank, an insurance company, or a retirement plan, you own bonds. You own safe assets. You're supposed to own them. So when yields spike, bond prices drop, and the paper value of safe assets shrinks. Most people don't feel that immediately, until they do. Because that's where stress leaks. Into balance sheets, into liquidity, into margin calls, into forced selling. And that's why I said earlier, something broke. Sometimes it's not one big explosion. Sometimes it's a bolt snapping inside the machine. Now, here's a cliffhanger I want you to hold in your mind as we keep going. If yields keep rising, the first place you'll see real panic won't be a headline about the dollar. It'll be a headline about orderly markets, temporary support, or financial stability tools. Those phrases are the code words. When they show up, it means the plumbing is getting noisy, and you don't want to be the person trying to buy insurance after the storm hits the roof. Now that's the US side, but the real story is that this is going global. Because if it was just America, the world could rotate into Europe or Japan as the safe alternative. Except Europe looks fragile, and Japan is flashing red. Let's talk about Japan. For decades, Japan was the quiet engine that made global borrowing cheaper. Their rates were low for so long that money flowed out of Japan into the rest of the world, buying treasuries, buying corporate bonds, buying everything. That steady outflow helped suppress yields globally. But now Japan is changing. Long-term Japanese bond yields are pushing into territory that makes the world pay attention. And Japan carries a debt load so massive that even small yield moves can create big stress. And when Japanese yields rise, something else happens. Carry trades start to unwind. That means money that used to borrow cheap yen and buy higher-yielding assets elsewhere starts coming home. And if that money comes home, it's not just a Japan problem. It's a global liquidity problem. Because a lot of what has floated world markets for years is the assumption that there will always be cheap funding somewhere. Japan was one of the biggest somewheres. Now, some people are downplaying this and saying, relax, Japan rising yields won't sink the world. Maybe. But here's what I know. Japan is often a leading indicator. It's like the canary in the coal mine, except the canary is holding an enormous amount of other people's debt. And when the canary starts coughing, you don't argue about whether it's serious. You check the air. History has shown a pattern. When bond markets get disorderly, central banks don't just stand back and watch. They intervene. They create facilities. They provide liquidity. They do whatever they have to do to stop a spiral. That's the playbook. They talk tough until the pipes start screaming. Then they open the liquidity valve. Now take that idea and apply it to today. If Japan's bond market gets disorderly, the playbook won't be do nothing. It will be some version of intervention. Buying, maturity tweaks, emergency facilities, quiet coordination, something that calms the market. And if you think coordination is conspiracy, let me ask you something. When the foundation of the global financial system is debt, and the debt market starts shaking, do you think policymakers just sit there politely? Or do you think they do whatever it takes to keep the machine running? That's the key question, and I want you to answer it in the comments. If global bond markets keep wobbling, what do you think the next central bank move is? More tightening or more liquidity? Because what you believe about that question determines how you position your savings. Now let's bring this back to gold and silver, because you might be wondering, why are metals reacting so violently? Here's my view. Gold and silver are not just commodities. They are the global report card on monetary credibility. When confidence is strong, metals can sit quietly, like a smoke detector with a silent light. When confidence cracks, metals start screaming. And what you're seeing right now looks like the early stages of a credibility shock that is spreading from geopolitics into bonds and from bonds into currencies. But I need to challenge one claim that's being thrown around. A lot of commentators say this is purely a flight from the dollar. I'm not convinced it's only that. I think it's a flight from the entire fiat structure. Because if every major government is running giant deficits, and every central bank is trapped between inflation and insolvency, then the safe haven isn't another currency. The safe haven is what can't be printed. And that's why even when the dollar tries to bounce, gold can still rip higher. It's not just a currency trade, it's a trust trade. Now, some people hear that and immediately jump to the most extreme word, hyperinflation. Let's be careful. Hyperinflation is rare. It usually comes with a collapse in output, a collapse in tax collection, and a total break in confidence. But you don't need hyperinflation to get crushed. You just need long stretches where your purchasing power bleeds faster than your income rises. That's the slow killer. And history teaches a hard lesson. When faith in the system cracks, gold behaves differently than most people expect. Silver, meanwhile, behaves like gold's louder, wilder cousin. It can overshoot both ways. It can scare you. It can reward you. That's why I never talk about silver without talking about emotional discipline. Now, let me address something else. Is it too late? In a normal bull market, you worry about buying late because valuations can mean revert. In a confidence crisis, you worry about being unprotected. That doesn't mean you throw your whole net worth into one thing. It means you build a strategy. And you stop treating money as just the number in your bank app. You treat it as a tool that has to survive a changing system. So if you've already got physical metal, I'd be cautious about trading in and out based on daily candles. This is not a day trader's environment. This is a positioning environment. But if you have zero exposure, or you've been procrastinating, this is the moment to get serious. Because in every historical reset, the window where you can easily swap paper for hard assets eventually narrows. And when it narrows, it does not narrow politely. It narrows suddenly, through premiums, shortages, delays, restrictions, or a mix of all four. Now, just before we go deeper, I want to point you to something practical. In the description, I've put bonus resources that can help you take action. There's a premium WhatsApp channel option, and there's also a channel membership option if you want to support the work and get access to extra material. And speaking of extra material, yes, we are offering members-only videos as well. These are not the quick uploads. These are the deep dives where a separate team helps me research the background, the numbers, the history, and the second-order effects. Content that's built specifically for premium members who want more than headlines. Now, let's do what most people won't do. Talk about the uncomfortable mechanics. When debt gets large enough, you eventually enter a phase where monetary policy stops being independent in practice, because the government's funding needs become the main pressure on the system. In that environment, the central bank can talk tough, but it cannot keep rates high forever without detonating the borrower. And the biggest borrower is the government. So the pressure builds to keep financing costs manageable. Sometimes that happens through explicit intervention. Other times it happens through a stealth approach, letting inflation run hotter than rates so the debt gets melted in real terms. That's why I keep bringing up real rates. Gold doesn't care about nominal rates. Gold cares about real rates and credibility. If rates are high but inflation is higher, your real return is negative. And negative real returns are a gift-wrapped advertisement for hard assets. Now, I can already hear the pushback, but official inflation is lower. Okay, let's do the adult version of that conversation. Even if the official number is lower, people feel the real number in rent, food, insurance, and services. Governments can change formulas. They can change baskets. They can change language. They can't change your receipts. So when the public feels squeezed, pressure rises for relief. And relief usually means spending. And spending usually means deficits. And deficits, again, link right back to borrowing and money creation. See how this loops? That loop is why this move in gold and silver isn't just a chart. It's a narrative shift. Now, I want a retention hook right here because the next part is the most important. In a minute, I'm going to tell you the two ways this ends. One is slow and one is fast. And the fast one is what metals are sniffing out right now. But first, I want to address Europe because Europe is the quiet accelerant in this story. Europe has structural issues, demographics, energy constraints, uneven growth, and political fragmentation. When a region like that gets hit with trade uncertainty and tariff threats, it doesn't just negotiate. It gets forced into policy reactions. Those reactions can be stimulus, subsidies, support for industries, again, spending. And spending in a high-debt world is not free. It's borrowed. Now here's where the fast ending begins to show itself. If multiple major regions simultaneously face higher borrowing costs, the system can hit a tipping point. You don't need everyone to default. You just need one major market to lose its smooth functioning. Because modern finance is built on collateral. Bonds are collateral. If the collateral wobbles, everything wobbles. And that's why a Japan bond shock can echo into US stocks, European credit, and even emerging markets. It's not because Japan is the whole world. It's because the world is interconnected through funding. Now let's talk about those two endings. The slow ending is controlled devaluation. That looks like policy support, mild recession, gradual inflation, and hard assets trending up over years. The fast ending is a confidence snap. That looks like a sudden repricing where people rush to exit paper claims at the same time, liquidity vanishes, and authorities rush in with extraordinary measures. If you're wondering which one we're in, look at volatility and emergency meetings. When you see politicians and central bankers scrambling, that's the fast ending trying to start. Now, I want to do something in the style of our community, answer a viewer question. A viewer wrote me recently, "John, if gold is exploding, should I sell my silver because it's volatile?" My answer is, it depends on why you own it. If you own silver as a short-term trade, volatility matters. If you own it as monetary insurance and as a potential upside kicker, then the goal isn't to flip it on every swing. The goal is to hold a core position through chaos. But you can also structure it. Some people hold a core and manage a small satellite. That way you don't sabotage your own protection while trying to be clever. Now, another viewer asked, what should I watch that tells me this move is real? Here are 3 things. 1. Watch whether metals rally even when the dollar tries to bounce. That signals a broader trust trade. 2. Watch whether dips get bought quickly. 3. Watch whether policymakers start using stability language. Because the moment they admit instability, even politely, the market hears the truth. Now, I promised you fresh perspective that most recycled scripts don't include, so here's the key. This is not a single direction stampede. It's a long rebalancing process. And rebalancing is about marginal flows. You don't need everyone to sell. You need enough big players to diversify consistently for long enough. That's what makes it sneaky. It's like water pressure behind a wall. The wall looks fine until it doesn't. Now, let's talk about what to watch next. Watch long-term yields in the US and Japan. Watch currency volatility. Watch emergency meetings and temporary facilities. And watch the messaging. When you hear coordinated statements about orderly markets, treat that like a smoke alarm, because they don't say that when everything is fine. They say that when they're trying to keep you calm while they do something big. Now, I want to give you a simple action plan, and I want it to be realistic. 1. Get your basics in order: cash buffer, reduce consumer debt, and a plan for expenses. 2. Build hard asset exposure that you can actually hold through volatility. 3. Diversify your counterparty risk. That means thinking about where your money sits and what rules apply to it. 4. Stay informed without getting addicted to panic. If you watch doom all day, you'll freeze. If you ignore everything, you'll get blindsided. The goal is calm preparedness. Now, I'm going to be blunt. A lot of people will only act when it becomes uncomfortable. They'll wait for shortages. They'll wait for restrictions. They'll wait for a crisis headline that forces them emotionally. But acting under stress usually means acting at the worst price and with the least options. So if you're listening to me right now and you feel that little uncomfortable feeling in your gut, that's not a weakness. That's your instincts catching up to reality. Now, remember, none of this is about perfection. It's about direction. You don't need to predict the exact day of the next move. You need to be positioned before the next move becomes obvious. Because once it's obvious, everyone piles in, and the system starts rationing access, whether through price, availability, or policy. Now, quick creative detour, because some of you ask me for motivation as much as analysis. If you want silver-related success stories, real examples of how people positioned early and built momentum, check the description and subscribe to the channel mentioned there as well. Seeing what's possible can sharpen your mindset. And while we're talking community, if you're doing well, if you've had a win in business, investing, career, anything, share a line or two in the comments. Your story might be the spark someone else needs to keep going. All right, back to the chain reaction. If tariffs escalate, global trade slows. If trade slows, growth slows. If growth slows, tax revenue disappoints. If tax revenue disappoints, deficits widen. If deficits widen, debt issuance rises. If issuance rises while buyers get nervous, yields rise. If yields rise, interest expense rises. And when interest expense rises enough, policymakers choose between austerity and money creation. You already know which one they choose. That chain reaction is why I don't treat gold and silver as investments first. I treat them as a vote. A vote against the idea that the solution to every problem is more paper. Now, I also need to address the elephant in the room. Is this the end of the dollar? People love that dramatic question. The truth is, reserve currencies don't vanish overnight. They decay. They weaken. They lose exclusivity. They get challenged by alternatives. And even if the dollar remains dominant in many transactions, it can still lose purchasing power aggressively. So if you're sitting around waiting for a headline that says, "The dollar is over," you'll miss the entire move. Because the move happens in the buying power, not in the label. Now, I want to bring you into this conversation. Question number 2 for the comments. Do you think the next big policy response will be a visible rescue, something like a public liquidity program, or a quiet rescue, where the rules change behind the scenes? Tell me which one you expect and why. Now, I have to mention something important about content itself. You've probably noticed a flood of copycat channels recycling the same ideas and slapping on new titles. I'm running a campaign to push back against that and keep this space clean and original. So if you value what I do, support me. Subscribe and comment Our John AG. It takes you 5 seconds, but it tells the algorithm that original work deserves to win. And yes, check the description. There are bonus resources down there, including the premium WhatsApp channel option, plus membership options, plus other tools I've curated for you. Now let's close this out with perspective. Gold and silver are not rising because the world is excited. They're rising because the world is nervous. They're rising because confidence is being repriced. They're rising because the debt-based model is reaching the stage where it must choose between pain now or devaluation later. And as always, the system chooses devaluation. But here's the twist, and this is the reason I'm not depressed about this. If you understand the game, you can protect yourself. You can build resilience. You can avoid being the person who works harder every year but gets poorer in real terms. You can be the person who sees the shift early and adjusts calmly. That's the whole mission of this channel. So here's what I want you to do right now. If you learned something, subscribe. If you've been here a while, hit the like button so more people see this. And drop a comment answering those questions. What's the next central bank move, and will the rescue be loud or quiet? And if you've got a success story, big or small, share it. I read the comments, and your wins help the whole community stay sharp. I'll keep tracking the bond market, Japan, and the geopolitical pressure points, and I'll keep translating it into plain English so you can act, not panic. Thanks for being here. Take care of yourself and take care of each other. This content is for education and general information only, not personal financial advice. Markets are risky, and you should make decisions based on your own research and, if needed, a qualified professional who understands your situation.